Can you see my screen? Can you see my screen,
Yes,
please?
we can see it now.
Okay, good. Good morning again. I remember that last week we've talked about significant economic presence. We've talked about Nigerian company. We've talked about situation where the profit of a Nigerian company can be subject to tax. We've talked about effect of branch and subsidiary company and how they are supposed to be subject to tax. We spoke about all this last week. And I remember we talked about filing of returns by a resident and non-resident company, and we put a time limit for filing returns. We talked about that. We talked about penalty for failure to file returns as when due, and so on and so forth. We also talked about book of accounts. In last week, we talked about payment of tax liability, and I told you that payment of tax liability comes in 4 different dimensions. We could pay tax liability on dividend, total profit, turnover, and minimum tax. In the last class, we talked about tax payment based on dividend, which of course I believe every one of us in this class understands that perfectly. So we move on straight to payment of tax liability on turnover. We talked about this last week where we said company will be assessed with turnover tax where the company says there is no accessible profit or there is accessible profit, but the accessible profit is less than expected. Therefore, the taxpayer shall be subject to tax on the fair proportion of their turnover. That was what we talked about in the last class. In the last class too, we introduced ourselves to companies income tax payments on profits. Now we said the company, for example, usually have profits, and these companies shall be subject to tax on their profits that they have made. According to Section 40 of CETA and the amendment that was introduced by Finance Act, we now have different type of companies. We have the small company, the medium-sized company, and the large-sized company. We say for a small company is a company that has a turnover that is less than 25 million, and by implication, their profit is not taxed. For a medium-sized company is a company with a turnover that is higher than 25 million, but less than 100 million. And by implication, their profit will be subject to tax at the rate of 20%. While a large company is a company that has a turnover that is more than 100 million. And by implication, those profits will be subject to tax at the rate of 30%. Okay, having said that, we'll quickly move on to implication for companies where they do not have profits. Now, that is where we subject the company to tax or minimum tax. Where a company seems not to have total profit, the company will be subject to tax or minimum tax. Or where the computed tax, the company has now computed tax, and the tax they computed is less than what minimum tax will result into, the company will be subject to tax or minimum tax. And how do you compute your minimum tax? Minimum tax is computed at the rate of 0.5% of turnover less frank investment income. And our frank investment income, as we have all known, is dividend. Okay. So today we're going to be quickly we're also going to talk about benefit of early payment of tax. We talked about this last week, where we said where a taxpayer is able to pay its tax liability within 90 days after the due dates, then the taxpayer will be entitled to, depending on the type of company the company is, will be entitled to a tax rebate or tax bonus, which is 1% for a large company and 2% for a medium-sized company. So today, I also remember that in our last class, we talked about donation, where we said donation is allowable provided the following conditions are met. Number one, we said only if the donation are made out of profit. The company that is making loss cannot be paying, cannot be granting donation. You make loss, cannot grant donation. So donation cannot be capital in nature. We said that in the last class. We now said this excludes university and other tertiary institutions where research are being conducted. So donation could be of capital in nature when it is for university education. We said donation cannot be more than 10% of the total profits for any year of assessment. Well, we also now said this donation could be more than 10% if it is donated to research institute or university. And in that case, we are now saying that your donation can be up to 15% of total profit or 25% of tax payable, whichever is higher. That is what the says. So we are given a list of bodies where when you make donations to them, those donations will be allowable. So these are the list of bodies. But how can you identify the bodies that when you make donations to is going to be allowable? It's very straightforward. Now, when the donation is to public fund, it is going to be allowable. When the donation is to statutory organization or institution, it is going to be allowable. If it is to ecclesiastical body, charitable organization, educational institution, or scientific institution, it is going to be allowable. All right, let's go ahead. So as I was saying, so how can you identify all these bodies? We said the public fund, the statutory bodies and institution, and ecclesiastical, charitable, benevolence, educational and scientific institution established in Nigeria. So when you make donations to all these bodies, it is going to be allowable. Take, for example, look at this. We have Boys Brigade, Boy Scouts, Christian Association of Nigeria, Christian Council of Nigeria, Muslim Nigerian Museum, Coca-Cola Research Institute, National Commission for Rehabilitation, Guest Guide, Red Cross, all those things are allowable. So we have so many of them that are allowable. Okay. Now, the one I want to also take attention to is this Finance Act 2020 that talks about implication of donation made by company during pandemic, natural disaster, and other exigency. Example of this situation that happened in Nigeria was COVID. During COVID, you will remember that a lot of people could not meet up with their responsibility. So governments, in its sense, in its right senses, also gave a company, any company that makes donation to support governments to be able to carry out its responsibility in terms of disaster recovery and pandemic that has crippled the economy. So the government says if any company makes donation to any state or agency or any similar fund that is designated for the purpose of pandemic, natural disaster, and other exigencies, these companies, any amount they contributed shall be allowed for the tax purpose, subject to a maximum of 10% of the accessible profit. Note, what is the maximum in this regard? It is 10% of the accessible profit. Unlike the regular donation that talks about 10% of total profit. This is talking about 10% of the accessible profit. 10% of their civil profits. I haven't understood that. That means your donation in this regard shall not be more than 10% of your civil profits when you make donation to a fund that is set up by government for the purpose of disaster recovery, for the purpose of pandemic, and any other exigency. So if you make donation to them in kind or in cash, such donation shall be a liable deduction. Now, what are we saying? When you say donation in kind, that means you have paid cash. You've given cash donations to government. When you say donation through the procurement or manufacturing of goods, you have given governments goods that you have manufactured. During the COVID period, you remember that Access Bank was one of the banks that donated 1 billion to government. Access Bank gave how much? 1 billion to government. 1 billion. That is to tell you that Access Bank will now be allowed to relieve this donation from their accessible profit. Accessible profit is the same thing as adjusted profit. Okay? So maximum of 10% is not going to be more than 10%. What does the act also say in a situation whereby the company is unable to recover all this donation that was made in the year that they made the donation? The act says they can carry forward for a maximum period of 2 years. They can carry forward for a maximum period of 2 years. So that donation in this form could be in kind, or could be that the company has procured an item and donated it to the government. What are the conditions for admissibility? Now, the person making the donation must show evidence and documentation of amounts paid or costs incurred. You must tell them that this is the evidence. You must show government that this is what I've been able to incur for this purpose. And just like I said the other time, I said the maximum allowable deduction in any year of assessment shall not be more than 10%, that is restricted to 10% of our civil profit after deduction of the donation. So it cannot be more than 10% of the civil profit. Where the company is unable to utilize the donation, it can be carried forward for a maximum period of 2 years, after which the donation will become lapsed. Now, and this is going to be first in, first out. The donation that you first made is the one that you first deduct before you deduct the other one. So that is that. The next one is, I also quickly made a note here for you guys to see that the donation for COVID is not the same thing as donation, the regular donation of the company. The regular donation of the company is restricted to 10% of the total profit. Why this is restricted to 10% of their civil profit? So the next one is Finance Act implication of expenses allowed in deriving tax exempt income. There are some income that are exempted from tax. And the fact that this income are exempted from tax, any expenses incurred or any expense incurred on this tax exempt income shall also not be liable for the purpose of income tax computation. We are saying that 10 million of your income is not taxable. So any expenses you incur in generating that 10 million that is not taxable would be disallowed for the purpose of determining the profit of the company for tax purpose. That's what we are saying. Example of expenses that will not be liable for tax purpose, we say penalty prescribed by law, tax or penalty paid on behalf of another person. And I put note there, I say it should be noted that where a contract is issued net of tax, any withholding tax or any other taxes borne by the taxpayer on behalf of the vendor will not be liable. We also said that any income that this taxpayer as generated that is exempted from tax, any expenses incurred in deriving such will not be allowable. Now, what about related party expenses? Any expenses incurred within or outside Nigeria involving related party that is not in compliance with transfer pricing regulation will not be allowed for tax purposes. A taxable person should ensure that any expenses incurred involving related party are at arm's length. They are at arm's length. Let's look at this illustration. Debo Bank PLC secured a loan, a pool of funds, which was wholly invested in generating an income of 1 billion, which is exempt from tax. Look at that. Debo Bank Limited secured a pool of funds which was wholly invested in generating an income of 1 billion. It was invested in generating an income of what? 1 billion. And this income is exempted from tax. The bank incurred the sum of 100 million by way of interest, administrative, and other operating costs pertaining to this investment. Now, don't forget, we said this 1 billion is exempted from tax. By implication, any expenses incurred on that 1 billion will be what? Exempted, will not be allowable for tax purpose. The company incurred another 200 million by way of interest, administrative, and other operating costs in its other banking business to generate 2 billion, which is only accessible to tax. You are required. Compute the adjusted profit. Now, in computing the adjusted profit, the 1 billion that this company generated that is exempted from tax will not be included. Now, any expenses that is related to the generation of that 1 billion will not be also be included. Now, that means 1 billion and the 100 million will not be included in our computation. In deriving our expenses, we only consider the 200 million that was used to generate the 2 billion that the company generated. So that is that. The next one, I want you guys to calculate this one and tell me my answer. Illustration number 8. Don't go and look at the solution. Illustration number 8. Oh yeah, what is my answer? What is my answer? Company XYZ incurred 200 million, 200,000 deductible expenses generating business profit of 1 million in the year ended 31st December 2019. You were informed that only the sum of 700,000 of the total business profit is accessible to tax, while the remaining 300,000 is tax exempt. How much of the expenses will be allowed for the purpose will be allowed for deduction purpose? How much?
Tax 200,000.
200,000 will be allowed. Okay, who
Yes,
else?
sir.
I think it's enough for 500.
500,000. Solid students.
I don't know. I'm not sure. I'm just saying.
How much? Who else? The answer is not 500,000. And the answer is not 200,000.
So I did 60,000.
Is it 60,000? It's not 60,000.
I think 140.
Is that much?
140,000.
140,000.
Yes, sir.
How did you get
140.
it?
Yeah, by
How-
rating 200,000 by 70%.
Okay.
That's 700,000 divided by 1 million times 200,000.
That's a very good one, Victor. Who else? Who else? Okay. So the answer is 140,000. How did we get 140,000? Now, when you look at what the examiner gave us, the examiner said 1 million was the entire profit. Abi, but out of the 1 million, 300K is tax exempt. So how do we get, we are given the total expense or expense of this company to be 200,000 to generate 1 million. So that means the only reasonable way to get our allowable expenses is to use the percentage of the profits to get the proportion of the profits, rather, to get the portion of the expenses that will be allowable. So if I say 700K, which is a portion allowable or taxable, divided by the entire 1 million, multiplied by 200,000, I will get 140. That is the expenses that is attributable to this 700K. Let's go.
So I have a question, please.
Go ahead.
The 200,000 expenses, the question
the
said
entire
is the 200,000 is deductible expenses.
It's for the entire 1 million now.
Yes, sir, but the question said is deductible.
So when they say it's deductible expenses, they're 1 million. And they still went further to tell you that out of the 300 million, out of the 1 million, 300 million is exempted. That means it's not everything that will be deductible. Do you understand me?
So the 700 portion is 140, right?
Yes. 140 million. 140,000, rather. That's what will be. And that's what I've simply done here in your calculation. Now, business reorganization and restructuring. This topic is very important. Examiner might ask this diet. And this cut across 3 acts. It cuts across Company Income Tax Act. It comes across, it's also in your Capital Gains Tax Act, and it's also in your Value Added Tax Act. So the examiner should say, what is the tax implication of business reorganization and restructuring? What is tax implication of business reorganization and restructuring? Now, when a company is restructured, okay, that means the asset of the company has been sold to another company for a better reorganization, okay? And the management is also transferred to another company. So when you're talking about business restructuring, we are saying the asset of the company has been transferred to another Nigerian company, or the asset of this company, the management of this company and asset employed in such trade is sold or transferred to another company. Now, but there are some concessions in which this will be allowed to scale through. when you are transferring your assets to another organization, to another company for a better reorganization, before you transfer such, there are steps that needs to be taken. One of the steps is that the company must inform the tax authority about this in writing. That I want to transfer, I want to sell my assets to another company. So the tax authority must be in the know. That's number one. Number two, the companies must prove to the satisfaction of the Federal Inland Revenue Service that one company has control over the other, or that the company are controlled by some other person or a member of a recognized group of companies. What we are trying to say here is that such a company must be related. Okay, there must be relationship. We have said number one, conditions for reorganization of a company. We have said number one, the tax authority must be informed. Number two, there must be relation between the company transferring to another company. They must have relationship. There must be connection. Number three, this connection or this relationship must not be less than 365 days. That is, must not be less than 1 year before the reorganization. Must be less than 1 year. Okay? It will not be less than 1 year at any point in time. Now, where these conditions are met, there are some concession that the taxpayer too will get, like relief. Number one, the commencement rule and cessation rule shall not be applicable. Number two, assets will be deemed to have been taken at tax using noun value. That is, balancing adjustment will not be applicable. They will not apply balancing adjustment. Like there is maybe you have balancing charge, and that will, because you have disposed your assets, there will be balancing charge or balancing allowance if we have really disposed. But in this regard, we are saying this is not going to be looked at as disposal. We are just looking at this, you are transferring your asset to your sister company. Okay. So that is that. So there's not going to be profit on disposal or loss on disposal. Do you understand me? And for the purpose of this, the assets will not be subject to capital gains tax. The asset disposal will not be subject to what? To capital gains tax. You are not going to say we are going to subject this asset to capital gains. No, you are not subjecting it to capital gains. Even though we know that the asset has been sold or transferred to a related company. Again, value-added tax will not be applicable. So look at what we have said. Number one, under conditions that must be met. We said, number one, there must be writing to the Federal Inland Revenue Service. Number two, we said the taxpayer must be related, as in the companies involved must be related, relationship. Now, number three, we said this relationship must not be less than 365 days before the reorganization. We now said after they have met these conditions, the other thing is the benefits for doing this. What are the concessions the tax authority is willing to give this kind of company? Number one, we are not going to apply the commencement rule to this company. No commencement rule will be applicable to this company. That's number one. Cessation rule will not also be applicable. Number two is that assets will be deemed to have been transferred to the company on at their tax noun value. So you just take the company and you take the assets at the tax noun value. Number next is that capital gains tax will not arise. Number next is that this company will not also be subject to tax on their sales. Will not be subject to value-added tax on their sales. So that is that. Any question? Any question? Now, at times a company might want to be smart. You have transferred your assets, and we have given you concession that this asset that you have transferred, you are not going to subject it to tax on your disposal. Capital gains tax will not arise. Value-added tax will not arise. This will only be firm if the company did not dispose the assets within 365 days of the company acquisition of the assets. This is what we are saying. We have said you have acquired the assets. When you acquire the assets, you are not expected. We said before the acquisition, both companies must be related at least within 365 days, at least 1 year before the transfer. We are now saying that in case you want to sell the asset, this asset that you want to sell, you must not sell this asset within 365 days after the asset was transferred to you. Do you have any question? The first one is acquisition. When you are acquiring the assets, you and that company must have been related, must have been a related company within 365 days, at least 365 days before the transaction occurred. We are now saying that now that you, as a company, has acquired the assets, you cannot sell the assets or transfer the assets within 1 year to another company. If you do that, all the concession that we have given you as a company will be taken off, and all the tax liability, all the penalty that is attributable to such will be charged to the company. Okay? That is it. Do you have any question?
Yes, sir.
Go ahead.
So in this case, we are looking at it from the buyer's perspective, right? Not the company that is selling.
Yes, buyer this time around.
Okay.
The buyer cannot sell it again. Do you understand me?
Yes, sir.
Okay, good. Any other question? The next one. Reconstituted company. Excuse me. Reconstituted company is the next one. Now, this reconstituted company is a company that was previously being carried on by a foreign company, and the asset is now being transferred to a Nigerian company by this foreign company. So it's a company incorporated in Nigeria, but it's being carried on by a foreign company. Do you understand me? The other one is a Nigerian company transferring to a sister company. This one is a Nigerian company that was being previously carried on by a foreign company, and this asset is now transferred to a Nigerian company. So that is what we call a reconstituted company. A reconstituted company is a company that is being carried, that is incorporated in Nigeria by a foreign company, and the asset is transferred to a Nigerian company for the business continuity. Okay, so we call this kind of company a reconstituted company. Now, what are the conditions for this reconstituted company to be able to sell the assets? Number one, we said the company must also obtain the consent of the Federal Inland Revenue Service before you can do that. Number two, the reconstituted company, the Federal Inland Revenue must be satisfied that the trade or business carried on by the company immediately after the incorporation of that company under the Company Income Act is not substantially different in nature from the trade or business previously carried on in Nigeria by the company. So that means now you have now transferred the assets to a company called reconstituted company. this reconstituted company, when they are going to be selling this, when they are going to be carrying out trading activities, they must also do the same activities that the foreign companies was doing before. You cannot deviate. So there must be, the company must continue to carry on the trade or business of the foreign company if they are going to be granted concession. Now, what are the concessions that this company will be granted? Number one, these companies will not be, cessation rule and commencement rule will not be applicable to this company. That's number one. Number two is that the assets shall be deemed to have been taken over at tax-free now value. By implication, that means the restructuring company shall not be entitled to initial allowance in respect of those assets. It's the same thing that we can match these two together, because if you are taking assets over at tax-free now value, it is obvious that you're not going to take the initial allowance. What is initial allowance? Initial allowance is the allowance granted to a taxpayer as incurred qualifying capital expenditure and put to production use on the same date, and is granted once throughout the useful life of the assets. It is granted once throughout the useful life of the asset. So if an asset is acquired during the activities of the foreign company that is being led by the foreigners, and that asset is now being transferred to you, you are not going to claim initial allowance again. You are only going to claim annual allowance, because it will be deemed that you have taken over the assets on tax-free now value, except if you now acquire another asset. If you did not acquire another asset, such assets cannot be granted initial allowance. The next one, any loss that is unrecovered, unrelieved losses from this reconstructed company, from this foreign company, has a maximum period of 4 years to be carried forward. A maximum period of 4 years. Remove this, and shall be carried forward indefinitely. No. The act does not say indefinitely for this kind of company, except if there is an adjustment today. As of today, there is no amendment to that. So for the reconstructed company, their losses are carried forward for a maximum period of 4 years. Unlike the other companies where they can carry forward their losses indefinitely, the reconstructed company can only carry forward its loss for a maximum period of 4 years. If you have any question, you can ask before we move on to the next one. Okay. In the absence of none, we move on to the next one. The next one that we're going to be looking at now is Finance Act implication on interest deductibility. Finance Act implication on interest deductibility. Ordinarily, before now, companies are expected to claim their interest as tax deductible on their profits. So when you collect loan for the purpose of business, you are expected, the company is expected to relieve this interest against their profits. And that is why in your SFM, your SFM lecturer will always tell you that loan is better than equity in financing business operation, because loan will be used, the interest on loan will be used to reduce our profits. Meanwhile, you cannot do that for equity. So we have always said that interest on loan is an liable reduction. But some companies are very, very intelligent to the extent that they are now managing their business operation, everything through loan, to the extent that this company in a particular year might not be paying taxes because of this loan. Therefore, if that is the case, in 2019 Finance Act, government introduced restriction to the amount of interest that a company can claim on the profits. And they now subject this to 30% of earnings before interest, tax, depreciation, and amortization. So you cannot take more than 30% of the company's earnings before interest, tax, depreciation, and amortization. You can't take more than 30%. So we are saying, for the purpose of computing your interest on loan that you have now received as a company shall not be more than 30% of interest, 30% of your earnings before interest, tax, depreciation, and amortization. So that is what all those means. Now, in that regard, what we are now trying to say here is that at every point in time, if you are going to be removing your interest, you must always check your earnings before interest and tax and multiply it by 30% and compare with your interest that is payable to the taxpayer, that is payable by the taxpayer. Now, if the interest that is going to be payable by the taxpayer is more than earning before 30% of earning before interest and tax, you must restrict it to 30%. That's what we are saying. Now, as a matter of fact, the tax authority knows that some companies will not follow this procedure. And therefore, any company that fails to follow this procedure, but that is by restricting their interest on a loan, will be liable to a penalty of 10% and interest as CBN monetary policy rates, plus a spread determined by a minister or any adjustment made by the service relating to the excess of interest charge in a year. How do you treat unutilized interest? Now that we have now said that, okay, because you cannot take the entire interest that you have incurred in a particular year, what are you going to be able to do? Now, you are not able to take that interest, but you can carry the interest forward for a maximum period of 5 years. So if you have an interest of 10 million, and because of the restriction, it is showing that you can only take 3 million in this particular year, okay? You cannot take more than that 3%, sorry, that 3 million in this particular year. That means the remaining 7 million must be carried forward. The remaining 7 million must be what? Carried forward for a maximum period of 10 years, sorry, 5 years. Now, what we are trying to say here again is that in terms of relieving the interest, the interest that is to be relieved will be based on first out basis. It is going to be what? Based on first out basis. So that is that. Now, what are the companies exempted from this rule? Number one, a Nigerian company that is operating in banking is exempted from this section. Nigerian company operating in bank and insurance are exempted for this, are exempted from this procedure. Nigerian banks or insurance companies that are parent to foreign companies, where Nigerian company paid interest to foreign subsidiary. So we are saying if you are parent to a foreign company, you are exempted. But a Nigerian company that is operating in bank and insurance that is a subsidiary to foreign company, does not apply to them. This does not apply to a foreign company, a Nigerian subsidiary of a foreign company, but it is applicable to a Nigerian company that has foreign subsidiary. Let me say it again. A Nigerian company that is a subsidiary of a foreign company is exempted from this. So if you pay interest, is exempted from this provision. Meanwhile, a Nigerian company that has a foreign subsidiary, this rule will be applicable to them. Okay, how do you compute your what's it called? Your interest. I gave a kind of conditions for the interest to be admissible. Number one, the interest on loan shall only be deducted if the relevant income or profit is not exempted from tax. Number one, that's number one. Number two, the interest satisfies the wholly reasonable, exclusive, and necessary principle. And number three, the interest satisfies the interest deductibility rule as explained above. Now, if that is the case, let's go to the rules for computation. Number one, interest on loan is tax deductible but shall be restricted to 30% of earnings before interest, tax, depreciation, and amortization. Number two, all interest of the business shall be considered in computing earnings before interest, tax, depreciation, and amortization. That is, interest on loan from third party, local or foreign partners. Next, compute qualifying interest for deduction. What is qualifying interest? This is the addition of all interest payments less exemption and add unrelieved interest of the previous year carry forward. We are going to be seeing that as we move on. Qualifying interest on loan to be deducted must be for the purpose of the business. Compare 30% of earnings before interest and tax and qualifying interest on loan calculated above. If 30% is greater than qualifying interest, there shall be no restriction. But if 30% is less than qualifying interest, there shall be restriction and the balance not allowed in the current year in which the interest relates shall be carried forward for a maximum period of 5 years until it becomes allowed. Any interest, any expenses incurred in generating tax exempt income shall be disallowed. Now, this is by format. This is my format for computing earnings before interest, tax, depreciation, and amortization where a stable profit is given. Look at it, where a stable profit is given. Where net profit is given, this is what we will do. Let's go. Where a stable profit is given, you know definitely that we would have disallowed, we have added back, for example, would have added back, what's it called? Would have added back interest, depreciation, amortization. So it should have been part of this before. It should have been part of this. We would have deducted all the interest would have deducted all the interest as allowable expenses. Abi, you remember? Would have deducted interest because we believe that interest is allowable. Would have deducted it before arriving at the net profit. That is why we're adding it back. Because we want to get earnings before interest, depreciation, and amortization. If we had tax, amortization, we would have added it back. That's why we are not saying add back depreciation again, because before you arrive at your assessable profit, we have added it back. But let's look at where net profit is given. Net profit, we will say add back your depreciation, add back amortization. Abi, this addition alone can give us our accessible profits. And we will also add back tax. Add back tax. So with this, we can say this place, this guy is the accessible profits. In this, your net profits, before you arrive at this net profit, you remember your interest on loan would have been allowable, right? So we would have said we are treated interest on loan as allowable before. So what would we do? We had it back here because we want to get earnings before interest and tax. So if that is the case, let's look at this illustration. Illustration number 9. XYZ Limited is a subsidiary of XYZ UK Limited. The following information was extracted from the financial statements of the Nigerian company for year 2020, year of assessment. You are given the following information. You have the net profit. The examiner informed you that in arriving at net profit, the following amounts of interest had been deducted: 400,000 and 200,000. 100,000 out of the amount paid to third party was in respect of loan, amount paid to third party was in respect of loan obtained in generating tax exempt income. You are required to calculate amount of interest deductible in 2020 year of assessment, explain the tax implication of excess interest not fully deducted in a year as a result of restriction of Section 7, Schedule 7 of Finance Act 2019. Who is explaining this number to us? What is the tax implication? What is the tax implication?
Sir, you said the implication is that the excess interest will be carried forward for a period of 5 years before it elapses.
Thank you. It's the only Prosper that we have in this class. You guys have not been contributing, except I've heard 2 persons' voice today, Prosper and Victor. Every other person in this class today, you are not saying anything. That's not right to go. It's not the right way to go, rather. Let's continue. So, the examiner said we should calculate the amount of interest deductible for 2020. Now, we said, you remember, I said net profits, Abi, is 400K. The total interest that we have is 600. Any before interest, tax, depreciation, and amortization is what? 1 million, Abi. So we calculate 30% of that. What is 30% of that? Is 300,000. Now, total interest deductible. Interest on loan, 400,000. Interest on loan from others, 200,000. Total interest expense is 600,000. Less interest for tax exempt profits. That you remember, any interest that you generate, any expenses which is the income that you use in generating is tax exempt, is also exempted, right? So we are exempting this from our computation. So our interest qualifying for deduction will be 500K. So look at it. So our qualifying interest is 500K. Our interest allowable by tax is 300K. So the maximum we can claim for this year is 300K. Meanwhile, the remaining balance of 200,000 will be carried forward. And that is what I've explained here. Any question? Okay, we move on to the next one. Move on to the next one. Assessment of total profits. This is where we're going to start work today. Total profits is a profit of the company from all sources. All sources of income will represent the total profit of the company. So if that is the case, your total profits will now be all your income that you have from all sources, add balancing charge, less loss relief, less capital allowance to get your total profits. That's how to get your total, and that's what we have done here simply. Adjusted profits, balancing charge, less loss relief, less capital allowance to get your total profits. Now, depending on the turnover of the company could be paying 30% or 20% as tax liability. So we move on. Let's do this illustration. Fortune Nigeria Limited, a reputable soap making company, is based in Lagos and registered over 10 years ago. The financial year end of the company is 31st December every year. The financial position of the company as of 31st December 2023 was as follows. We are given. Additional information. Included in the other income was for sum of 850,000 and as profit on disposal of assets. Salaries and wages included housing allowance for 10 senior management staff who were paid 200,000 each per annum. 1/4 of the expenses on rent was paid on the apartment occupied by the father of the managing director. Half of the advertisement cost was incurred on sponsorship of television program, where airtime was allocated for the promotion of their products. Public relation and entertainment of 3 million included a 308,000 paid as commission to a sales agent. Miscellaneous expenses, we have cost of computer hardware, furniture and fitting, cost of oil and lubricants, printing and stationery. The amount incurred as gift and donation included the following: donation to Egba community for town hall development meeting 360,000, donation to University College of Ibadan 500,000, gift to Humanitarian 490,000. Breakdown of subscription is as follows: General Institute of General Accountant 200,000, Recognized Trade Association 100,000, staff to Nigerian Institute of Management 100,000, and capital allowance 720,000. You are required to complete the tax liability of Fortune Nigeria Limited for the year ended. Ignore minimum tax computation. We are also told to what difference will it make to your tax liability computed in one above if the turnover of the company is 90,000 instead of 1,100,000 instead of above. Let's go. The first thing I will do is take our net profit. We adjust the net profit. Our net profit in this question is 1088. Additional information number 1. Interest included in other income was 850,000 and as profit on disposal. Is it taxable or not taxable income?
It's not taxable income.
So what do we do to non-taxable income?
We deduct it from the net profit.
The next one, salaries and wages included housing allowance of 10 senior management staff who were paid the sum of 200,000 each per year. What is the implication of that?
So I think it's allowable expenses.
It is allowable, so we are not doing anything to that.
We ignore it.
The next one. 1/4 of the expenses on rent was paid on the apartment occupied by the father of the managing director. So what do? We go to the question, take 1/4 rent and disallow it. Abi?
Yes.
Yeah.
Good. The next one. Half of the television cost was incurred in sponsorship of television program where time were allocated. Is it allowable or not allowable?
It's allowable, sir.
Okay. Public relation and entertainment of 308 paid to sales commission. Allowable or not? Not allowable.
Allowable.
Allowable, good. Next, cost of computer hardware 680. Allowable or not allowable? It's allowable.
It's allowed.
Furniture and fitting, allowable or not allowable?
Not
It is
allowable.
allowed.
It's allowed. Okay. Cost of lubricants, allowable or not allowable?
Allowable.
Printing and stationery, allowable or not allowable?
Allowable.
Okay. Donation to a Egba community for town hall, allowable or not allowable?
Disallowable.
I'm only hearing one voice.
Disallow.
Disallowable.
Good. Donation to University College of Ibadan, allowable or disallowable?
Disallowable.
Allowable. Allowable.
I heard disallowable from someone. Give the gubernatorial candidates, allowable or disallowable?
Disallowable.
Allowable.
Okay. Subscription to your institute, allowable or not allowable?
Allowable.
Allowable.
Recognized trade organization, allowable or not allowable?
Allowable.
Allowable.
Institute of Management, allowable or not allowable?
Allowable.
Allowable.
Okay. Good. So that is that. We will now go after you have treated your additional information. You now go back to the body of the question. Duplication, allowable or not allowable?
Not allowable.
Not allowable.
That's the only thing that is not allowable there. Every other thing. So you now go and put this in your question. See it. These are the things that you told me. Okay. We will get our adjusted profits with less capital allowance, and at the same time, we get our total profit. The total profit, we will calculate company income tax, and you also calculate education tax on accessible profits. Okay? Education tax on total profits, accessible profit on education tax on accessible profits, company income tax on total profits. Okay. If that is the case, examiner is asking you, what would happen if this company were to be a company with a turnover that is less than 100 million? That means we are going to use 20% to assess them to tax, right? So we have computed it here, and we have used 20% to assess them to tax. So that's that. This is not correct. Because now they told us that the turnover
It will be lower.
is lower. Okay. We have treated it. See where we treated it. This 10 million was the difference. You get?
Yes.
Yeah. Overstatement of turnover. So we have removed it. So this is what we have now. Now, this is the one that we want to do today in class. And this will take us time to complete. But let's see where we can get to before we move. Someone should read this for us, please. This is one of the questions that came out in your past question that we have adopted. Prosper, read it for us, please.
Okay. Tobiloba Nigeria Limited commenced business as a manufacturer of stationery on 31st January 2022. The company in December 2021 acquired all the assets and liabilities of a foreign company operating in Nigeria. Edition Incorporated and got it reconstituted for a turnaround and better profitability. The directors of the newly reconstituted company have just considered the draft financial statements and annual tax returns prepared by the financial accountant for the year ended December 31st, 2022. During the board meeting, diverse opinions were expressed by the members of the treatment of dividends received. During the board meeting, diverse opinions were expressed by the members on the treatment of dividends received of 3,600,000 by the company on equity holdings in another Nigerian public limited liability company. The dividends received are also part of the proposed profit to be distributed to the shareholders of the company in form of dividend payments. All efforts made by the financial accountant to explain the position of the Company Income Tax Act 2004 as amended on dividends were rebuffed by the majority of the members. Being a reconstituted company, one of the directors posited that the possibility of the company enjoying some tax relief / incentive from government, which may impact the company's profitability positively, was very high. The managing director of the company, following the decision of the board, has contacted your firm of tax consultants to help provide professional advice on the issue discussed. The following details were extracted from the company financial record for the year ended 31st December 2022. So I should read the additional information.
Yes, ma'am. Let's start. Let's analyze this first statement. During the board meeting, diverse opinions were expressed by the members on the treatment of dividend received. 3.6 by the company on equity holding in another Nigerian public limited liability company. This dividend is what? Dividend received, right?
Yes.
Yeah. So it is different from dividend paid. Are you getting me?
Yes,
Remember, we talked about Section 19. This is not talking about Section 19. They have received dividend, okay? And when you receive a dividend, it is going to be treated as what?
frank investment.
Thank you, my dear. Frank investment. So the dividend received are also part of the profits to be distributed to the shareholder of the company in form of dividend payments. You remember when we were doing our, what was it called? Section 19 of SITA, we said where the dividend to be distributed is from frank investment income, such will be exempted from what? From tax. The dividend received, okay, all efforts made by the financial accountant to explain the position of the company's income tax on the dividend were rebuffed by the majority of the board. Being a reconstituted company, look at it again. Being a reconstituted company, number 2, reconstituted company. One of the directors posited that the possibility of the company enjoying some tax reliefs and incentives, concession that I told you about, tax relief and incentive. So if the examiner asks you, what are the tax reliefs and incentives from government for a constituted company? You know them. We have done them today. Which is what I called concession. Okay? Now, yeah. Which may impact the company's profitability positively was very high. The managing director of the company, following the decision of the board, has contacted your firm of a tax consultant to help provide professional advice on the issues discussed. The following details were extracted from the company. Now, the first thing that we need to do when you have any question, you go to the additional information. You start all your solution from the additional information. So let's take it one after the other. Number 1, subscription and donation. Subscription to Manufacturing Association of Nigeria, 400. Allow or not allow?
Allow, sir.
Allow.
Good. Donation to State Flood Victim Relief Fund. Allow or not allow?
Allowed.
Allowed. But you remember, we said this amount shall not be more than 10% of our stable profit. Abi? So,
Yes.
yes. The first thing I'm going to do in this question is to first disallow it and calculate my stable profit before donation and say 110 over 110 multiplied by the stable profit. I will get the donation. If the 10 over 110 is more than this donation, I will take this for 4.9. But if it is less, I'll take that value that I calculated. Let me say it again. How do you calculate donation? How do you calculate donation? I want to write. Oh, no, I don't want that. So if you have to calculate donation, your donation will be 10 over 110 multiplied by accessible profits before donation. Do you understand me? So to get your donation during pandemic or exigency, this is what you will do. You say 10 over 110 multiplied by accessible profit before donation. Now let's take, for example, that our accessible profit before donation is 11,000. Try to understand what I'm trying to do. So if I say 10 over 110 multiplied by 11,000, I will have 1,000. That is my donation. I will now say my accessible profits before donation is 110. Sorry, 11, Abi, 11,000. Donation allowable, 1,000. Accessible profits after donation, 10,000. If I say 10% of 10,000, we have 1,000. Do you understand what I'm trying to do? Do you understand what I'm trying to do?
Yeah.
Good.
It's not clear, sir.
Let me start again. Look at this formula. Do you understand this formula? This one. So to get your allowable donation, you remember the donation during COVID, all that it said it shall be restricted to 10% of accessible profits. Abi? So what I said, the first thing I am going to do is to first disallow the donation. everything, disallow it. You will now calculate your accessible profit before donation. Your accessible profit before donation will be your accessible profit before donation. We now say, let's assume it is 11,000. So 11,000 multiplied by the donation. The donation here is 11,000. 10% divided by 110 multiplied by 11,000, you will get 1,000. That is your donation allowable. So we now say accessible profit before donation is 11,000. Donation is 1,000. When you subtract it from it, you have 10,000. If you take 10% directly of this 10,000, you will have this 1,000. That's what we are trying to do. Now, let's assume that the donation that you have was 2005. The maximum you can take is what? Is 1,000. That is why we need to do this test at every point in time. So that is the treatment of that. Donation to Royalty Club. To Royalty Club. Big Boys Association. Is it allowed or not allowed? It is not allowed. Let's go. The next one. Allowance for doubtful debts. General provision is not allowed. So we just take that one. General provision is not allowed. The next one. Repairs of manufacturing plants. Is it allowed? No or yes? Is it allowed? Repair of
Is
manufacturing
allowed.
Allowed.
allowed. Improvement of building. Is it allowed or not allowed?
Not
Allowed.
allowed.
Not allowed.
Not
Apex.
allowed.
Why?
It's capital in nature.
It's capital in nature. By implication, you have to go and introduce this as capital, as part of the building that you're going to calculate your capital allowance on. Let's go. Maintenance of motor vehicle. Allow or not allow? Allow.
Allowed.
Legal fees, audit fee, allow or not allow?
Allowed.
Legal fee, reacquisition of land, of lease, allow or not allow?
Not allowed.
Why? Why? Why is it not allowed? It is not allowed because it is capital in nature. Okay, that is why it's not allowed. When you are acquiring a land, any cost you incur in acquisition of the lease or maybe land, it is not allowed. So this is in respect of lease, is not allowed. We move on. Expenses increase of share capital, allow or not allow? Allow or not allow?
Allowed.
Not allowed.
Not
Yes.
allowed.
Fines for traffic offense, allow or not allow?
Not allowed.
Christmas gifts to customer.
Allowed.
You are very happy to say that on Salam. You're very happy to say it. So let's go. Now, we are given tax nominal value of all these assets. They say tax nominal value of qualifying capital expenditure as at December 31st, 2020 is this. So they gave us date of acquisition and they give us the amount. Now, if we were told that an asset was acquired in 2018, and we're in 2021 year of assessment, because this would have been 2019 year of assessment, right? And we're in 2021 year of assessment. How many years would this asset would have used? How many years would they have used? Let's say it again. These assets that was acquired in 2018, if you are introducing it for the purpose of capital allowance, when would you have introduced it?
2019.
2018.
2019, my dear students, 2019, okay? Because it's on preceding year basis. Now, and we are in year tax nominal value as at year 2021. That means this asset would have used how many years? In 2019, it has used 1 year. Abi? 2020, 2 years. 2021, 3 years. So we are given the tax nominal value as at 3 years. So that means we are going to divide this up by 7. Let's go. Let me see what I did. So we divide it by 7, but that is as at 2020. What's it called? As at 2022, it has used in 2018, so 2019 1, 2020 2, 2021 3. Abi? Now, but the examiner said we should calculate for 2000 and when. Let's see their profits. The profit that we are given was 2022. Abi?
Yes.
Yeah. So that means in 2023, the asset would have used 4 years before we bring it on. Abi? So the asset is supposed to use 10 years. That is, building is supposed to use 10 years. Look at our financial statements. We are given 2022. That means our year of assessment will be 2023. Abi? Before 2023, that asset has used how many years? It has used 2019, 1, 2020, 2, 2021, 3, 2022, 4. Abi? So, and this is 2023 year of assessment. So before we bring it on, we'll first divide that by 10 minus 4. It has used 4 years before we brought it on, right? We'll bring it in this year. So it has used 4 years. So that's why we divided this by 4 years. 10 minus 4. It has used 4 years before we bring it on. The same thing. Look at this other assets. It was acquired in 2018. The same thing that is applicable to this will be applicable to this. What about this that was acquired in 2020? In 2020, that means the first year would have been 2021, 2022, Abi. So it has used 2 years before now. Abi, I'll divide it by 4 minus 2 because that asset is supposed to use 4 years. 4 minus 2. Let me explain it again. Let me re-explain it so that you can understand what I'm saying. Look at this year that we're given the assets, 2020. The year we are is 2023. 2022, but For the purpose of tax, it will be 2023. So we are now saying this asset, as and when they acquired it, we will say in year 2021, the assets, sorry, in 2019, year 1, 2020, year 2, 2023. Let's go again. Sorry, 2019, year 1, 2020, year 2, 2021, year 3, 2022, year 4. In 2022, this asset has used 4 years. So what I'm going to do is that I am going to say this asset ordinarily is supposed to use 10 years. But before now, the asset has used 4 years before we are bringing it on. Abi? So I'm going to say 10 minus 4. Okay? That is what I'm bringing into my books as my annual allowance for that year. So in 2023, I am having 10 minus 4, 4.2 divided by 10 minus 4. The same thing for this guy. But for this guy, this asset would have only used 2 years. This would have only used 2 years. This would have only used 1 year before we bring it on. Now, in year 2022, we acquire additional assets. So those additional assets that we acquired in 2022, we are going to introduce them for the purpose of capital allowance also. So let's go and look at the way we calculated the capital allowance. Now, for existing asset, I said tax nominal value divided by n minus x. N here is the number of years the asset is supposed to use. X is the number of years the asset has used. The asset has used 4 years for the first one. The second one, 4 years. The second one, 4 years. Third one, 4 years. The third one, 4 years. Sorry, 2 years. And last one has 1 year. Who is that? Can you mute your phone if you are not asking questions? We are also told that they acquired new assets. They acquired industrial building. Let's go and see it. The new asset that was acquired, they acquired industrial building. The industrial building that was acquired was the improvement of building. This improvement of building, 1.4. We introduce it as a new asset. Improvement of building is capital in nature. So we are going to calculate initial allowance and annual allowance on that, which we have done. On delivery van, we acquired for 1.4. Delivery van is supposed to use 4 years. Furniture and fitting will use 5 years because the annual allowance rate is 20%. And for motor, for plants, it's going to use 4 years because annual allowance rate for plants is 4 years. So that is what we calculated here. That's what we calculated here. This 1.2 is not for industrial building, no, it's for plant and machinery. Let's go and see how much was it acquired for. The additional 1.2 was for plant and machinery, was for this. So that is an error when I was trying to adjust it. So this 1.2 million minus 600 divided by 4 is for plant and machinery, it's for this guy. Do you understand? So it's not supposed to be here, it's supposed to be in this place, in this column. It's for plant and machinery. So that is how to calculate the capital allowance. So I've also brought them into our computation here. So that is that. So let's go back to our body of the question. We have said the frank investment income is not allowed, right? So again, flood victim, we have disallowed flood victim. We are not supposed to disallow it, but I want to show you that we need to calculate the allowable deduction. You get allowable donation. So flood victim, we have disallowed it. We disallowed all what we are supposed to disallow. So we got our civil profit before donation, just like I explained the other time. I'll now come here again.
Hello, Mr. Chris.
Yes.
We just had a notification now that our case study class is about to start. 10:30.
Okay. We'll soon be running off.
All right, sir.
Thank you. So we'll quickly look at this. So restricted. So we said we calculate all our allowable expenses, disallowable expenses. We have done all those, and we will now take out. We say we calculate our donation. We said donation shall be restricted to 10 over 110 of this, which is 56,180. We multiply by it. We got this. We will now compare the two, just like I said. Now, where your donation restriction is more than the actual donation of this, you are going to take the actual donation. But assuming this was 14 million, we would have taken 5 million. So that is why we took this 4.9, because it was not more than the donation. So that is that. So you get your civil profit and you go and calculate your company income tax using that civil profit. We have our capital allowance that we have calculated in this year. We calculate the capital allowance of this, which is this total that we have here. So this is a brought forward. The one we calculated now is this. We brought it forward. This loss was brought forward, and you first relieve capital allowance, loss from your profit before you consider capital allowance. So the total loss here at taking all our profits. So no profit for that year. We cannot claim capital allowance. But we need to go and check for minimum tax. So our minimum tax will now be computed on turnover. We said turnover and all other income. So we have that. We remove frank investment income to have our net turnover. On that, we calculate our 0.5% of our net turnover to have this. So the company will not pay company income tax, but they will pay minimum tax, and they will also pay tertiary education tax. Good day to you. Study the material, if you have any question. All right, that will be all for today. Goodbye.
All right, thank you, sir.
See you next Saturday.
Thank you, sir.
All right.